Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering what is a 401k or tax-deferred 401k and what is a Roth 401k. I covered this last week, but I didn't like the video. It was sort of a very rough draft 1.0. I had just basically covered what I had written on my draft, which that was a terrible idea. So I finished up, made it official, and released it on my website. So that's what we're going to be covering today. I think it's important for everyone to know what is a 401k and what is a Roth 401k, because this is probably the most common investment that most people in the working area invest their money in without knowing that they're really invested in the stock market. So we're also going to be covering some facts between a 401k and Roth 401k. Is a 401k worth it? Are any of them worth it? And then some alternatives to investing in your 401k if that's something you would like to do as well. So of course, right off the bat, prior to investing, you should always consider paying off your high interest debt. I would consider anything over 5% high interest, such as student loans, credit cards. Credit cards can get 18% or higher. If you have $1,000 in credit card debt, that thing's going to hit you and compound against you. So it's going to basically wipe out any sort of earnings you may achieve in, S&P 500. Normal return 7 to 10%. So if you're getting hit with an 18% credit card, that's going to work double against you. So also create your rainy day fund. I would say 3 to 6 months of living expenses, at least to cover your essentials: shelter, food, water, utilities, in case you're traveling, you get let go, you're moving jobs, something doesn't work right. You always want to have a rainy day fund. So prior to beginning our little thing, if you are brand new to my channel, I do make stock market investment style videos weekly, so do consider subscribing for future financial videos. You can go ahead and hit my icon on the bottom right hand corner if you're on the computer, or just hit the subscribe button if you're on your phone. And let's get into it. So what is a pre-tax 401k or Roth 401k? Of course, a 401k, it was enacted back in 1979. It was intended to allow taxpayers a break on taxes on their deferred income. Basically, their earned income, they were able to deduct it in that year and not have to pay any taxes on it. So contributions are made on a pre-tax basis, meaning that the employer takes the money out of a paycheck and transfers it into the employee's retirement plan prior to withholding taxes. When the employee begins taking distributions, he or she will have to pay income tax on those distributions. The income tax will be based on the employee's tax bracket at that time of distribution. So the pre-tax 401k, the main question you want to ask yourself here: what income bracket do you see yourself in the future? Right now, you may be sitting at a 15% tax bracket, 25% tax bracket, and that may not be very high, but ask yourself, where do you see yourself being in the future? Could you be making $200,000 a year and you'll be hitting, the higher tax end bracket, or do you think you'll actually lose income throughout your career? Now, me myself, I intend to increase my tax bracket, so that's where we're going to be covering the Roth 401k. So the Roth 401k is a bit newer. It was enacted back in 1997, so it's about 20 years old now. It was introduced with the passage of the Taxpayer Relief Act. Contributions are made after an employer withholds taxes. Because the employee has already had their taxes paid on the money, he or she will not owe taxes on distributions normally, unless you receive company matches. So I don't see a lot of people covering this, so that's why I want to include in this article. I think it's something important to know. If you have a Roth 401k, it's different than a Roth IRA because company matches will affect your Roth 401k. So company matches: if the employee receives a company match on a Roth contribution, the company match is a pre-tax contribution, meaning that the funds that result from the company matches and the associated growth, dividends, interest will be subject to regular income tax when distributions are drawn at retirement. So, similar to a 401k, the employee portion that is received inside your Roth 401k will be taxed when at 59.5 or 60 or 70 when you need to begin taking contributions. So non-principal withdrawals, if your 401k is less than 5 years old and you are under 59 and a half, your not principal may be subject to taxes and penalties. So inside your Roth 401k, you can always withdraw any contributions that you've made to that without being hit with taxes, because that was after tax money that was put into your Roth 401k. So that won't get penalized at all. However, if you do withdraw any capital gains, any dividends that you've received, you will have to pay taxes, and then you'll pay a fine of 10% for withdrawing prior to 59 and a half, unless you meet some of the following requirements. It's the first time, your first home purchase, you can have 10% as a lifetime maximum. You're also able to have it qualified for educational expenses if you're doing some college courses, maybe some certifications for some higher education. Higher education. It really depends. I think it's a broad thing. You would have to look it up. Or if there's a death, 100% disability, or if there's any unreimbursed medical expenses or health insurance if you're not employed. So if you're not covered under some sort of health insurance, then you could withdraw out of your 401k. Put it against whatever your medical expense would be, and you wouldn't be able to tax deduct it from your that tax year, I believe, and you wouldn't have to pay taxes on it, and then you wouldn't get hit with that fee though. So if you've met the 5-year holding requirement and you're at least 59 and a half, you can withdraw money from your 401k without paying any taxes or penalties on your contributions. But again, your company matches will get taxed. So that is why those are the differences between the 401k. Essentially, this is pre-tax. The employer and the employee is putting in pre-tax money that will be taxed at your tax bracket in the future. The Roth 401k, you're taking after-tax money, putting it into the account, and then your company is putting pre-tax contributions, and then your capital gains, your dividends, your interest will not be subject to being taxed in the future. However, your company matches will be taxed. Now, some of the facts that I wanted to include, the 401k is the most popular retirement plan because most small to large businesses, they offer the 401k or Roth 401k. The 401k and the Roth 401k contributions limit remains at $18,000 for 2017. Contributions, some people like to go with the 401k because maybe they're in a 35% tax bracket, but if they contributed $18,000, they might be able to knock themselves down into the 28% or the 25% tax bracket, depending on how it goes. If you have spouse and whatnot, or husband, spouse, whatever, if you guys both put in $18,000, which is the max, that's $32,000 between the both of you, knocking down your couple, your tax deferred income by $32,000 for that year. So you may be able to drop down into a lower tax bracket. So distributions must begin no later than age 70 and a half for a 401k, regardless if it's a 401k or Roth 401k, unless you are still working and not a 5% owner in a business, such as your own business. So typically a 401k and Roth 401k offer 5 or more mutual funds that invest in various sectors of the financial markets. Some 401k plans do offer shares of their employer stock. I worked at a company called Lithium Motors. They offered their stock to the employees, and they offered a discount on the stock for purchasing their employee stock. So I thought that was interesting. 401ks, they usually have a range of 5 to 20 limited funds that are professionally managed, and these are normally the ones that you're going to get stuck in right off the bat by default if you do not change it. Professionally managed, meaning that they usually come with some high expense ratios. 14% of the 401k funds that are available to you do not beat the market on any given year, and 0% normally beat the market over the long term. And there was a link there. If you kind of hover over the 0%, it does take you over to a New York Times article of how many mutual funds routinely beat the market, and it's 0%. So you always want to go in there and customize and take a look at what you're offered. 401ks often come with a number of fees. They come with annual fees, legal fees, trustee fees, transaction fees, stewardship fees, bookkeeping, maintenance fees, finder's fees, and more. So I took a look at one of my 401ks I had in the past, and every month they do a maintenance fee of like 10, I get paid my dividends, then I get hit with a maintenance fee, then I get like a service fee for them servicing my account with a fee and my dividends. So they knock me down, I get paid some sort of dividends, and then I get knocked down $10 for that maintenance fee. So I'm looking to roll over my old 401k into my new company's 401k, or maybe rolling over my 401k into an IRA. So that is something I am looking at here in the future, and if I do some sort of thing, I'll go ahead and make a video on that whole style. So is a 401k worth it? So ask yourself these 4 questions. Does your company offer a match program? Normal match is 2 to 5%, and I would say any company that offers a match program, I think that's free money that they're giving you for investing in yourself in your future. So I would always contribute to match the match. What is your current tax bracket? Could contributing to a 401k lower you into a lower tiered tax bracket? So again, back to that contributions in a standard 401k, if you're earning, you're getting paid, or you're getting taxed at 35%, you and your spouse both contribute the maximum $18,000. That lowers your tax deferred income back by $32,000. That may be able to lower you into a lower tax bracket when you're paying less taxes on your current at this current time. So how long do you plan on staying with your company? 401ks can convert over to IRAs. I say how long do you plan on staying with your company, because a lot of times they have this little snippet in there. I forgot what it's called now, but if you're not with the company over 5 years, you don't get a percentage of what they contributed towards you. I have it in my other article. Every year they usually allow you to keep a percentage of what they've contributed. I can't think of the thing right now, but if they contributed $5,000 and you've been there a year, you only get, say, 20%. If you're there 2 years and they contributed $8,000, now you get 40%. So you would get, say, $3,400, and then after 5 years you would get the full amount that they contributed towards you. That's why I put that snippet in there. Can you change it? If your company's 401k has really high fees, talk to your HR and see if they can pick a plan that offers low fee index funds such as Vanguards. My company offers Vanguard, so I will most likely choose a Vanguard or something that follows the S&P 500 index or one of the indexes. Those are some of the options that they offer. So alternatives to investing in a 401k or Roth 401k. So instead of investing in a Roth 401k or 401k, you take that money yourself, you invest 5% into a specific account that's designed to start your own business. You invest that money into a specialized account. I didn't have any examples there. You take that money and buy land, some sort of farmland that you know will be worth more in the future. Or you take that money and you buy some rental property. You create yourself an LLC. You start getting some rental properties underneath your actual business. So of course you would want to start your own business, some sort of an LLC for real estate, and then you would buy some rental properties underneath it so you can get some tax deductions. So those are some things that you could do instead of investing in your 401k or Roth 401k. If you guys are interested in anything else, check out the article. If there's anything that was confusing at all, go ahead and let me know in the comments below. If there's anything that you would like included or changed or modified, if something doesn't make sense, go ahead and let me know in the comments below. I want to make this as clear as possible for people that are looking to invest in their 401ks or Roth 401ks, because again, it's the most popular retirement plan that people see. It's offered at their job, and a lot of people don't get that the standard standard funds that are offered are professionally managed, and they often have like 2% expense ratios. So if you contributed $5,000 and you have a fee of ratio of 2.5, that's $2.50 per every thousand. If you put five, that's what, $10, nearly $10 in a year. That could be working for you, but again, it's being deducted, and that just compounds year after year. And eventually, when you're sitting there with $100,000 in your 401k, and they're doing their ratios and such, their annual fees, you're getting $20, $30, $100 knocked out of your account per year. So that is it for this video. I hope everyone found it entertaining. I do want to thank everyone for watching up into this point. If you liked the video, hit the like button below. Please remember to subscribe if you are brand new to my channel for future financial videos. If you have any questions about anything that was covered in the article, or if you would like to see more information covered in the article, go ahead and let me know in the comments below. I will research the information and put it into the article. And of course, if you just want to say hello, also say hello in the article, below in the comments. Thank you for tuning in, and I will see you next time. Have a great day. Bye bye.